Over the last few years, stock option interest has exploded, and many new traders have entered the market. This is good, as it increases competition and tightens option pricing. However, the majority of new traders fail to understand the strategies on how to make consistent profits with options. So, we have set out to change that. You may or may not understand what an option is right away, but it's important not to give up. At first, options seem complex and puzzling for everyone due to their many dimensions. But just like anything else, the more you study, the easier they'll become. I also suggest that you take notes while you follow along, so you have something to refer back to for future reference. Just keep with it, and I promise it will all start to make perfect sense. I refer to options as the major leagues of investing. Option trading done right is where the serious investment money is made. But in order to make that money, you need to make sure you understand options, because almost all new traders start out losing money. Traders who take both our beginning and advanced course will get the proper foundation, the right tools, and the proper trading strategies to make consistent profits month after month with options. Members at our website, optionstrategiesinsider.com, will also always get real-time trade notifications of our exact trades, which on average have a 90% plus success rate. In the end, our students will have the complete picture on how to maximize their reward while balancing returns intelligently against risk. So, what is an option? An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a set date. The seller of the contract sells this right and is obligated to fulfill the buyer in exchange for receiving a payment called a premium. To simplify things, let's run through an example. Say we own a trucking company, and we think gas prices, which are currently trading at $2.50 a gallon, are going to surge higher over the next year, and we want to protect ourselves against raising prices. We could buy a contract that allows us to purchase gas for $2.80 a gallon, up to 10,000 gallons, for a price of 10 cents per gallon. Because this contract controls 10,000 gallons and it carries a premium of 10 cents a gallon, this contract will cost us $1,000 today. Now, why would anyone pay for a contract giving them the right to buy gas at $2.80 a gallon when it's currently priced at only $2.50 a gallon? That's a good question. And if gas prices stayed under $2.80, we would never exercise the contract. Why would we if gas prices in the open market are cheaper? This would result in a loss of that $1,000 premium we purchased the contract for. The seller of the contract would get $1,000 just for taking on risk that never ended up being an issue. Good for them. However, if gas prices were to shoot up to, say, $3.50 a gallon, this would be a totally different story. Because we purchased the right to buy gas at a price of $2.80, we can now force the seller to honor the agreement and sell us up to 10,000 gallons of gas for only $2.80. When everyone else pays $3.50. Our total savings is 70 cents per gallon times 10,000 gallons, or $7,000. Of course, we did have to pay $1,000 for this contract, so our total profit for buying this insurance on raising gas prices is going to be $6,000. This is basically how a call option works. There are going to be a few technical terms that come along with option trading. That's just the nature of the business. It can sound like a foreign language at first, but please don't let that stop you from learning how to trade options. There's not that much, and through repetition, it's going to all make sense very soon. Once you actually get through the course, which is full of examples and actual live trading, it's all going to make perfect sense. The understanding of what is actually happening will come with time. My promise to you is that I will get you there in the shortest amount of time possible, so you can start making money with options sooner rather than later. With that said, we have to lay a basic foundation. There are two types of options: call option contracts and put option contracts. A call option gives the buyer the right to purchase stock at a predetermined price and within a specified time period. This means there will be a limit to how long the buyer may wait. The more time given, the more the contract will cost. The seller of a call option is obligated to fulfill the rights of the buyer if that buyer chooses to exercise those rights. A put option is similar to a call option in regard to the rights given to the buyer. However, a put option works a little different. A put buyer can sell the stock at a predetermined price and within a specified time period. The seller of a put option is obligated to fulfill the rights of the buyer if they so choose to exercise their rights. So, now that we know a little about options, I want to cover some key option trading terms. First, call options control the purchase of stock, while put options control the sale of stock. Buyers of options, both calls and puts, have the rights, while sellers have an obligation to fulfill the rights of the buyer at the agreed-upon price and before the predetermined date. This agreed-upon price is known as the strike price, and the predetermined date is what we refer to as the option's expiration. One more point. One option contract, under normal circumstances, controls 100 shares of stock for both calls and puts. Okay, I know that's a lot to take in. So how about we run through some examples demonstrating how all this works? Let's pull together the terminology we just learned in a real scenario. Here, we're going to look at calls first to get a better understanding of why options are so powerful. For instance, we want to initiate a long position in the company XYZ, which is trading at $50. If we buy the stock, that means we're risking $50 times the amount of shares we want to buy. If we buy 100 shares, that's a $5,000 investment. However, options allow us to take a long position in the stock where we can avoid actually buying the stock and risking so much capital. First, we need to decide where we think the stock is going and what we can afford to risk. Over the next 2 months, if we think the stock is going to trade up to $58 and the price of a 55 strike price call option is $1.50, this will give us the ability to purchase the stock for the price of $55 anytime within the next 2 months. If the stock does trade up to $58, that's going to be great, as we can exercise the call option and buy the stock for $55, even though it's currently trading at $58. Our total cost per share is going to be the $55 plus the $1.50 cost of the option, for a total of $56.50. Because we can now sell the stock for $58, we just made a nice return of $1.50. This position only cost us $1.50. Being so, we have made a 100% return on capital in just 2 months, a far better return on capital versus just purchasing the stock. Another benefit of buying a call instead of the stock is that our max loss is also capped at the price we paid for the option. Had we purchased the stock and it traded down to $40, we would have lost $1,000. But because we instead decided to purchase an option, our max loss is limited to the cost of the option, no matter how far the stock trades down. Remember, one option contract controls 100 shares of stock. So if we purchase one contract for $1.50, our max loss is only $150. Next, let's take a look at put options. These are very similar to calls, but instead of giving us the right to buy stock, puts give us the right to sell stock. If we're looking to take a short position in the stock, we can either sell the stock short or buy puts. A lot of new traders understand calls, but it takes a little longer to get their heads around puts. People often buy puts instead of shorting stock, but it's also very common to use puts to protect a current portfolio, just like drivers buy car insurance to protect their vehicle. Although you have to pay insurance premiums, most hope they never actually use it. However, if there's an accident, they know they are protected. Puts are often used in a similar fashion. They allow the buyer of the put to sell stock at a predetermined price, and if a stock they own gets crushed, the investor has the right to exercise the puts and sell the position out, saving themselves from a larger loss. Let's look at stock XYZ again, which has now traded up to $62. And this time, we want to protect our profits against the stock trading back down to $50 in the near future. Here, we can look to buy a 55 put, which is priced at $1.25. If the stock trades down to $50, like we thought, That would mean we have the right to sell the stock at the 55 strike price, with the current market value of the stock at $50 for a $5 profit, minus the $1.25 we paid for the option, giving us a net profit of $3.75. Not bad for only a $1.25 investment. Okay, everyone. I hope you find this first lesson engaging and you're starting to get excited about option trading. In the next lesson, we're going to have a look at some of the benefits, warnings, and why investors might want to sell options. I look forward to seeing you there.